It doesn't matter if you're building your financial nest egg in a 401k, IRA, crypto, real estate, gold, whatever the asset is. There are three tried and true strategies that, if you follow them, will help you build wealth over the long run. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're discussing strategies to help you build your retirement savings, regardless of the asset class you choose to invest in. So, Brian, let's get right to it. What's the first strategy?
This is one you hear all the time, but before you say, yeah, I already know this, and click away from this video, hear me out on this. When most of us here start saving early and consistently invest, we think of being an early 20-something just starting out in the workforce. But if you bear with me, I'm going to show you how, even if you're 43 right now or older, you can consistently invest over the next 30 years. You'll be amazed at how much you can actually accomplish.
Yeah.
Yes, the sooner you start investing, the bigger advantage of time and compound interest you have. But even if you're 35 or 45 right now, time is still on your side.
Well, time plus consistency builds wealth.
Yes, it does. Let me show you the power of this. If you start saving early and contribute regularly to your retirement savings with a 7% annual growth over the next 30 years, the growth of your savings can be substantial. To show you just how powerful even small amounts invested each month can be, let's assume you start with an initial investment of $100 and then you contribute $100 every month for the next 30 years.
Okay.
Use a compound interest calculator from investor.gov. The estimated future value of your savings can be calculated as following. Your monthly contributions, $100. Annual interest rate, 7%, and the time period is 30 years. So the estimated future value of your savings after that 30 years, assuming a 7% return, would be approximately $114,114.
So, Brian, could be in their 40s and just starting out and still see a decent return on their money.
Exactly. Let's mix it up a little bit because I want to show you the power of time plus consistency when it comes to wealth building.
Okay.
Let's say you're 45 and you want to retire at 68. So 100 or 23 years from now, right?
123. I like it.
123
You got
years.
so much time.
Sorry. You start with a $200 initial investment and you can contribute $200 a month for the next 23 years. Same 7% annual rate of return.
Okay.
The estimated future value of your savings after 23 years, assuming that 7% return, would be approximately $129,194.
So again, it doesn't matter if we're talking about investing in workplace retirement accounts like 401ks or simple IRAs or stocks or crypto.
Exactly. Maybe real estate or commodities are your area of interest and focus.
Okay, got it.
This actually leads nicely into the second strategy, which is not to be too concentrated in one asset class and not to be afraid to shift your focus from one investment asset to another, depending on what the market is doing or because of economic conditions, or because it makes more sense tax-wise to do so.
Yeah, it's like our mutual mentor says, be in what's working and out of what's not.
It's such a simple thing, but I'd be amazed at how many people don't adhere to that advice.
Yeah.
Before I dive deeper into strategy two, a quick side note about taxes. Do you understand the tax consequences of what you're investing in?
Yeah.
If not, make that your homework because it changes all the time. So you got to stay on top of that.
Well, and that's another reason to subscribe to this channel because we regularly put out IRS tax code updates and regulation updates to help you understand the tax consequences of what you're invested in. So hit that subscribe button. While you're at it, if you're watching and you like the content of this video, hit that like button.
Definitely.
All right, Brian, sorry for interrupting there. Plug the channel. Floor is yours again.
It's all right. We live in a new world with a lot more options to build retirement savings and wealth than than the past sense, right?
Yeah.
I met a lot of younger people who refuse to contribute to their 401k because they don't trust it.
Yeah.
Instead, they're focused on building a crypto portfolio or investing in crypto businesses, and that's okay. They're doing what works for them. But here's the deal. You've got to make sure, should economic or your own financial conditions change, that you're flexible.
Yeah.
You've got to regularly reevaluate what you're contributing to each investment asset and make sure it's still working for you.
Yeah, perfect example of this was 2020 for me. I decided not to max out my IRA. Instead, I took 80% of, I think it was $6,000 I could contribute at the time. And I bought a bunch of Bitcoin and Ethereum at rock bottom prices. If I'd had the money to do more in both, I would have done it. But, I had a divorce and it wasn't cheap. So the
Yeah.
next year, what I did was I maxed out my IRA and I seriously pulled back on my crypto purchases or my crypto buys because the prices were way too high. So it's just, like you said, flexible.
Yeah, my point exactly. Had you been too strict with your investment strategy and force yourself to max out your Roth IRA in 2020, you would not have had the gains you did with your Bitcoin and your Ethereum.
No, I would not have.
Here's another way to be flexible. Let's say you could care less about using your 401k to save for retirement.
Mm-hmm.
Even if you aren't sold on the 401k, you could just contribute enough to get the company match, which is free money, and also 100% return on your contributions. There's nowhere else that you're going to find that. So get that free money and then do something else with your money. Plus, in doing so, you're also going to get a tax deduction on the money that you contributed to your 401k for that tax year.
Well, I know that if I had a 401k right now, I'd get the match and I'd spend the bulk of my money funding other investments, but get that match. So it's
Sure.
just me though. All right, Brian, let's move on to strategy 3.
This is a big one. You want to always try and have cash on the sidelines in case an opportunity emerges, which it will. It always does. You're always kicking yourself in the ass because you don't have enough cash to pounce on an opportunity when it arises. Think about that. Think of any time an opportunity came up and you're thinking, oh my God, where am I going to get that cash from?
Yeah.
That's why you need this.
Well, on the flip side of this, if you have cash on the sidelines and an emergency happens, which they always do, whether your dog has to have surgery or you've got something going on health-wise,
Washer
or
goes
your
out.
air condition, exactly. It can derail you from being consistent in investing because now the money earmarked for investments has to go to cover your butt.
Yeah, great point. This is why I love the Roth IRA as an emergency savings account and a retirement savings vehicle. Your contributions can always be withdrawn tax-free or could be used for an emergency or for a different investment opportunity when it arises.
Sure.
So you leave your earnings in the account, and while the funds sit there, they're still invested for growth.
Absolutely. Here's the thing. If you want to know more about how to use the Roth IRA as an emergency account, check out a video we did on this. We're going to drop that link below. Also, if you liked the content of this video, hit the like button, help us grow this channel. Don't forget to subscribe. Brian and I put out videos on the daily that help you make the best decisions for your financial future. And leave us a comment. We want to know what you're investing in. Just,
Awesome.
we're always answering questions in the comments. So anyway, all right, Brian, this has been a great conversation. Thanks for this. Appreciate it. And thanks to everyone who watched.
Thanks, everyone. Have a great day.